All right, Frank Magana, how are you?
I'm doing great, Mark. Great to see you.
Great to see you as well. For those that don't know, I'm Marc Ellis with Keller Williams Realty based in Pasadena, California. And Frank, if you can introduce yourself.
Yes, my name is Frank Magana. I am with Mason McDuffie Mortgage Corporation.
All right. You and I have been working together for several years now. We've closed some successful transactions with clients, and I really appreciate the service that you offer the clients that we work with.
Well, thank you, Mark. I appreciate it as well, and thank you for the vote of confidence to assisting your clients from day one.
Yes, sir. Yes, sir. So let's dive into it. I always like to make sure I'm updating my clients, past clients, family, friends, new people that I meet. Let's hit the conversation head on. Mortgage rates have been ticking up the last couple of years. There's
Yes,
concerns
sir.
about affordability. There's concerns about whether or not it's the right time to buy. And will the market crash? Will rates fall? Am I buying at the height of the market? Will I lose if I buy now? And I like to, you know, address those head on. And my encouragement to people is always that the benefits of home ownership are still intact,
Absolutely.
right?
Absolutely.
And so the path is in the math. That's my slogan. The path is in the math.
I like that.
And people are still building equity. They're still building equity, even given the mortgage rates, right? As over time, property values have shown us that they appreciate in value as the mortgage balance drops over time, and that
Yes,
is the equity. And there's a fixed payment, even at a higher mortgage rate than what we've been used to the last several years. That payment on that mortgage is fixed for a long term,
that's correct.
and that's a benefit. Rents are rising and rents are not fixed for a long period of time. And, being able to have full control of the property, transferring that property to your heirs, being able to remodel and upgrade and improve the value of that property is also another benefit.
Absolutely.
Mhm.
Absolutely.
So right now, I'll let you kind of dive into where we are. Mortgage rates are in the eights, right, at this point.
Yeah, rates, as you mentioned earlier, rates have risen and they've risen significantly over the last couple of years. We were very spoiled during COVID, where rates got as low as 2%. But, we knew it wasn't going to stay there. And we're really more of what I would consider a normal market. Um, it's always a shock when rates go up so rapidly, kind of like gas prices, right? Um, we're always concerned about how much we pay at the pump, and I get it. But California real estate has always been a winning investment. And like you say, the path is in the math. I always tell my customers, you got to get in the game because oftentimes you have, if you wait too long, or if you just wait to get into the game, it could basically be out of reach. And if you can get in the game today, regardless of what rates are doing, I think in the next 5 years, it's a nice retirement plan for you. It's nice to have that equity build up, as you mentioned earlier. Interest rates, you're right, are sitting around the eights, high sevens, low eights. One of the ways that we are dealing with higher interest rates to have a little bit of that payment shock relief is doing what we call a 2-1 buy down. Basically, what a 2-1 buy down is you have an established fixed rate of interest. Let's just call it 8%. We buy it down to 6%. And in the first year, your payment will be at 6%. Your second year, the payment will go to 7%. And the third and final adjustment, it will be at 8% for the remaining 30 years of that particular mortgage. You still must qualify at the 8%, but because of the payment, the payment shock, it's not as significant. Your payment is reduced by 2% of interest over the first 12 months. So we do see that happening quite often, and a lot of times, because of the nature of the fees that are associated with buy downs, the buyer cannot absorb all of those fees. So we oftentimes get assistance from the seller to pick up some of those fees, or what we call origination points.
Yes.
Um, and one of the things that we're forecasting, basically, when I say we, Fannie Mae, Freddie Mac, the Mortgage Bankers Association, they are forecasting that rates are going to soften a little bit. They anticipate by the end of 2024 that we're going to be seeing rates, somewhere around 6.7, maybe 6.5, which is a significant difference from 8%, depending upon the size of your loan as well. So if you've got a $100,000 loan, you won't see that much of a difference in payment. But if you have an $800,000 loan, it's pretty significant. So yeah, rates are forecasted to come down. I wish my crystal ball worked, so I couldn't tell you for sure, but that's what we anticipate.
Yeah, exactly. That's what I'm gathering too from the real estate and mortgage economists that I follow. You mentioned the Mortgage Bankers Association. I see content from them as well. As you said on our call earlier, that there's a lot of factors that impact our economy. So it's difficult for anybody to forecast or predict, but we can make some estimations.
Correct.
Yeah, at some point, we're expecting that mortgage rates will trickle down, and that gives people an opportunity to refinance, and that only lowers the mortgage payment.
Well, that is correct.
Yeah.
That is correct.
You mentioned something about the seller covering some cost on that rate buy down. So I want to touch on the seller concessions real quick.
Sure.
And that's where I come in too, right? On the purchase side, when it's time to write those offers for the clients, we're strategic about certain things that we ask for. And seller concessions is one of those
Sure.
requests, right? So
That's
seller
correct.
concessions, it basically means that the seller obviously has equity that they're cashing in on, and the lender allows the seller to contribute credits towards a few things. It could be the buyer's closing costs. It could be towards a buyer's rate buy down.
Mhm.
And it can also, for conventional loans, you mentioned that the conventional loans, the private mortgage insurance premium can be paid for in full, and the seller can actually credit the funds for that, which would eliminate a private mortgage insurance monthly payment for the borrower. And that would reduce the housing payment for people who are putting down less than 20%.
That's absolutely correct. When you have mortgage insurance, there's two schools of thought on a conventional loan. There's always a monthly premium that can be associated with that. What a lot of clients aren't aware of is there is a one lump sum premium that you could pay to buy that rate out. And as you and I have talked about, the path is in the math, right? So if the client can get that premium prepaid, then that monthly premium, that mortgage insurance premium, will no longer be effective, and that premium's paid now completely. So we just do the math. Does it make sense? And if it does make sense, the seller can in fact contribute to that and pay for that. Yes, and that is just want to just touch base one more time so our customers don't get confused. That's only applicable on conventional loans, not on FHA loans.
Right. Understood. Understood. And then you mentioned for the VA loan, which is for veterans, the veteran loan is still as much as 100% financing. A veteran does not have to make a down payment, and the veteran loan does not include private mortgage insurance at all.
That is correct. The only thing that the VA loan does include is what's called a funding fee. And that funding fee is financed into the mortgage. How we determine if the client, the veteran, is exempt from that is when we get their certificate of eligibility. Oftentimes, and I just dealt with one of my VA clients recently that purchased a home in Arizona, they were exempt, which is great because it could be as high as 3% on the mortgage. So if they have a $300,000 mortgage, that's $9,000 that they save by being exempt. We don't know that until we actually get the certificate of eligibility from the VA, but that is the only thing that VA charges is a funding fee. No PMI, no mortgage insurance is applicable.
Yeah. Okay. Great information. And, obviously we're focused on people who may be on the fence, concerned about home ownership right now in terms of the cost, the affordability.
Of
And
course.
um, the other folks are diving right in. We have people who are purchasing all the time. I just shared a few weeks ago, or maybe last week, that over 33,000 transactions have closed in LA County alone for single family homes.
Yep.
And so, that's just to give people a perspective. If I were to include all of the counties in Southern California, that number would swell up. And then when we look across the country nationally, there's transactions that are happening at all income levels.
Absolutely.
Yeah.
Absolutely, there are.
Yeah. So I don't want people to be afraid of these rates or be concerned that, this market's going to come crashing down. And the last time we actually saw our industry crash down was that Great Recession, right? That we
Right.
started to see the cracks in the walls in 2007, and by
Yep.
2008, we saw the dive happen. And even then, those who had safe and secure mortgage loans, they were able to make their payments, and they continued to drop their balance. And then in a few short years, we started seeing property values appreciate, and then they just kept going.
Oh, absolutely.
Yeah.
Absolutely.
So
And to your point, those people that became homeowners, even in what we call a market that was all of a sudden you bought at the top end and then the market dived in 2008 and you thought you lost all this money in a short period of time, that equity position rebounded tenfold.
that's right.
So those people that were able to dive in and maintain their household, continue to make their payments, they didn't overextend themselves. They were, because a lot of people used their home as an ATM machine. They just kept getting cash out, paid off bills, then those credit cards went up again. They learn from their mistakes. But those people that, like you put it, stayed put, did their due diligence, continued to make their payments. 7 years later, wow, it was unbelievable, and it's still unbelievable. Those people that are current homeowners are reaping some tremendous benefits.
That's right. The return on investment has been amazing. And even now, because of tight inventory, right? We have tighter inventory now. We still have strong buyer demand that exceeds that inventory. And so we're still seeing appreciation, even in a market where mortgage rates have been rising. The appreciation is there.
Yes, it is. Yes, it is. And to that degree, this might be another call that we can get on sometime soon. We talk about investment properties. A lot of clients right now that have reaped that benefit of home ownership are now getting into the investment realm.
That's right. That's right. And I'll segue into that real quick. The other opportunity that people have to assist with the higher rates are investing in a 2-unit or a triplex or
Yep,
a 4-unit, right? For anyone that
correct.
can enjoy that lifestyle, right? Where they have neighbors, on site with them. They're actually collecting rent from those neighbors, and that's contributing to the mortgage payment. It might be as much as 40%, might be as much as 50%, depending on the scenario. And so that's a great way to leverage the investment, is to invest in a 2 to 4 unit and occupy one of the units. And that rental income is actually being added towards the borrower's income to qualify for the financing for those properties, right?
That is absolutely correct. I know many people have delved into the unit side of things because of exactly what you just mentioned. Um, the income that you're receiving on a 4-unit building where you're occupying as a primary residence, the other 3 units are virtually could pay for your entire mortgage, especially with rents being so high today. It's a definite advantage for someone who can get into that type of an acquisition. Units for many, many, many years have been out there, and people have taken advantage of it. Yes, there's something to say about buying your own primary residence and being, on your own, and not have any, like you mentioned, other neighbors on your lot. But for those that need that kind of assistance with their mortgage payment, wow, what an opportunity for people, because not only can they benefit from assistance from their tenants, but guess what? Down the line, they've already bought into it. Now down the line, they get the equity appreciation, so they can rent out their primary residence and go buy another house.
That is absolutely correct. You hit the nail on the head. And one of the most recent updates we'll add to this conversation is the ADU, the accessory dwelling unit.
Yes, yes,
So a single family home can right now have a garage conversion or a second unit that's, built from the ground up. And now the rental income that can be generated from that ADU is also being used to help the borrower qualify to purchase that property.
that's correct. And you see a lot of that going on throughout Los Angeles in general. LA County, a lot of homes have remodeled, and because of the density of their lot, they can add easily an ADU, get it fully permitted, and now we can use that as income if they were going to sell that property for the borrower to buy a house with additional income.
That's right. And, I'll say it like this. I haven't done the math and I don't know if you have, but if that ADU generates, let's say, $2,000 in monthly income, what is the effective mortgage rate? Right? If I'm originating a loan right now and I'm at 8%, but I have $2,000 of rental income from a tenant that's in an ADU, then it definitely shifts my mortgage payment down. I would love to see what that effective interest rate would be.
That's true. I mean, we could do that math as well. Off the top of my head, I'm going to say if you're at 8%, $2,000 is probably going to be somewhere in the mid to high sixes.
Gotcha.
So that's pretty significant.
It
That's
is.
a great way to look at it. Um, Again, I'm gonna take your phrase, path is in the math. That's all we have to do today, right? We need to educate and show our customers what's the best course of action for them. I know I tell my clients all the time, I've been in this business for a long time, but my job and how I earn a living is to, put my clients' best interests first, and to make sure that they understand what we're doing, how we get them there. And that's really what it's all about, is education. And if it doesn't make sense, we don't do it. If it does make sense, we really give it our best shot and figure out what's the best course of action for our customers.
Gotcha. Um, that's a real life scenario. A past client has a single family home. Kids have gotten older. He's in a space where he can downsize now, right? And when I say space, I mean the period of life that he's in. And so he says, "Hey, Mark, I've got equity. I've had this property for, several years now. And what would it look like for me to sell and reinvest my proceeds into a 2 to 4 unit where I could leverage the rental income from the other units? I'm really
Sure.
interested in that." So that's the math that I'm assisting him with now. And if the math makes sense, then, you and I will probably work together in terms of getting you the opportunity to review his financials and actually give him an official loan approval.
Yes.
Okay. So
Yeah.
we'll talk about that after our call here. And
Sure.
how easy is it for someone to apply with you so that the financials can be reviewed and you can give them loan program options?
Oh, with the advent of technology, it's pretty quick. What I do is I provide the client with my app. So basically, they can apply online at their convenience, whether it's in their home, at work, or even on their phone. So it's very convenient. Within Once I get an application and I get all the appropriate documentation, which they can download to the app as well, so they don't have to be piecemealing me things. They can put everything in the app within within a matter of hours. Once I know the application is complete and I have all the supporting data, I can give them a pre-approval immediately. Sometimes there's things that are missing. So if I need to get some missing pieces, I like to get everything up front so we don't leave anything to chance. Because once I tell a client we can close this transaction, I want to make sure that we can close the transaction. And escrow periods are taking 30 days or less. It's not uncommon for us to close transactions in 3 weeks or less if necessary. Oftentimes, and I know I'm probably getting a little ahead of ourselves right now, but oftentimes when we have a conventional loan and we put it through our automated system, sometimes we will get an appraisal waiver. So that cuts off 10 days. So almost immediately. So we can close transactions relatively quickly today. And through technology, everything can be a seamless transaction.
Okay, sounds good. Well, I appreciate your time today, Frank. I'll definitely get this information out to all of those folks that are within my database. Thank you for the update, and we'll continue to work together to help these folks make a sound investment.
Likewise, Mark, I appreciate as always the opportunity and can't wait to get our next deal put together. And again, great seeing you today, and you have a blessed week, my friend.
All right, same to you. Thanks, Frank.
You bet.